Welcome to the latest edition of The Bull, the Bear, and You, as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to be using. Well, the markets have been dropping, and we're now close to, if not in, correction territory. We'll talk about that and what you should do. And also, is there another problem lurking on the horizon that most people don't know about? We'll tell you what that is. It is coming up in this episode of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Carrie Coghill of Coghill Investment Strategies, Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, and Michael Godwin of Fergasso Advisors. Thanks for joining us on this interesting day in the last couple of weeks, as a matter of fact. It has been several years since we've had a tumble like this in the markets. Since their all-time closing highs, all of the markets are down. The Dow dropping nearly 7%, the S&P 500 down more than 8.5%, maybe closer to 9% now, and the NASDAQ giving up more than 13%. Most of you have said you would not be surprised if we would enter into a correction territory this year. So the NASDAQ has already entered into that level, and then some. The S&P 500, as I just mentioned, is very close to doing that. So there are a lot of questions about what's happening in the markets right now. Carrie, I will begin with you. Welcome back. You've been gone for the last couple of sessions, out there working very hard, plowing the fields, trying to get more customers or whatever you're doing. So my question to you to start things off is, what is happening, and have we reached correction territory, even though we might be a little tiny percentage off?
I think we'll probably get there. As you know, at the beginning of this year, when we had discussions, we talked about the fact that the market was priced for perfection, and that, you know, I know people don't want to hear this, and it's a lot more complicated at this point, but, you know, corrections are actually healthy. And we are seeing that. We didn't have a correction last year. So, you know, you kind of have to take that step back in order to move forward. So we don't get too alarmed about that. I think the bigger question on investors' minds is more so about, is this going to be a recession? And given everything that's coming out, maybe, but here's the good news. We've had recessions before. So, you know, what we're doing is we're really looking at the facts, what's happening day to day, and the facts change hour by hour. So we have to keep that in mind. But that's also a point that I want to make, that when the facts do change hour by hour, you really shouldn't be changing your investment strategy. But it's important to understand, what is your investment strategy? What is your risk tolerance? And can you deal with the volatility that we're now seeing? It's been a long time since we've had this kind of volatility.
Michael, you've been someone who's said you look at the glass half full. Are you still looking at it half full?
I'm the most pessimistic person on this panel by far, Stacey, so I appreciate that. But I am one that I remember talking about this in the beginning of the year. I said my highest conviction sort of theme or thesis for 2025 was that we will have an at least 10 to 15% correction this year. Now, we're getting close to it. I think Carrie's probably right. We'll hit it at some point. But I do think it's just a correction. What I've been saying to some clients over the past few days is I think there's really three ways that you can have a recession. One is if you have a spike in interest rates. That's one of the reasons why I thought last year we would have had a recession, because the Fed jacked up interest rates so much over the past couple of years. But that didn't happen because the economy still remained very, very strong and resilient. The second way is if you have a spike in unemployment, which we're just not there yet. The unemployment rate is at 4.1%. The jobs nut report last Friday was okay. I think unemployment goes up a little bit, but not to the point where it's going to create a big recession. And the third way, Stacey, is if, you know, through some sort of exogenous shock, right? That's what happened with COVID. It's something you really can't predict, or you don't really see in the data that just kind of shocks the economy. And I think that's what we're seeing right now, right? This is all being stemmed from essentially trade policy and trade policy uncertainty, the tariff wars. And we, again, you know, with the back and forth with Trump and Canada right now, the tariffs being hiked up, that's just causing the market to sell off again. Trade policy uncertainty is so much higher today than it was in Trump's first term. I think this is going to get ironed out in the next, pick a time frame, 3, 4, 5, 6 months or so. So if you have the fortitude to really look past the next few months, we're going to inevitably have a bit of volatility, a lot of uncertainty, a lot of ups and downs in the market. I think if you can extend the horizon to 6 months, a lot of this stuff is going to get ironed out, because Trump, if anything, he's very, very cognizant of his perception in the media, in the U.S., with his constituents, whatnot. At some point, I think this is going to get rolled back, or at least roll back to a point where companies are going to have a lot more clarity on what the future looks like for their business, because they can't hire, they can't really do much in regards to planning out the next 6 months of their business. So I think that kind of gets rolled back, and you'll start to see a little bit more of a trough once that happens.
All right, Kim, the last time we met, you said that you were going shopping. How's that been? Have you,
Well,
are you happy with what you bought?
actually, shopping does not mean buying. Shopping means looking. So yeah, even though I am in a male-dominated industry, and especially my little corner of stock picking, you have to get your definitions right. And for me, shopping means not buying. I am lining up, and I don't think I bought anything. Maybe I did, but it wasn't significant. I mean, if I'm sitting here going, what could I have bought? A little bit around the edges. But things are getting interesting now. And I have to tell you, as the probably most optimistic person on this panel, and I'm optimistic always for the longer term, not the shorter term, I still see, I see this correction as a logical step because, well, everything's up in the air over the whole tariffs and trade and all that. I get that. And I agree with the panel so far that 6 months of roughness is going to pay off at some point. We'll get to some new equilibrium. But what really gets me excited is all the crazy stuff that's been happening in the last 18 months is unwinding. And what I mean by that is the overbuilding of importance of large language models in the world of AI has kind of come to, well, a brick wall. We'll just put it that way. So most of the stuff that has been selling off the most was the most bought things, like in the Magnificent Seven. And I think that's correct. I think the investors didn't really understand what they were buying. They had way too high expectations for the technology. Over time, it's going to be great, but it wasn't going to deliver in the time period that most investors had. So I am overjoyed to see a lot of the really crazy stuff selling back to a more reasonable level and to a level that looks like it reflects what we think is going to go on in the next 36 months with those names. And I'm talking to you, Google, Microsoft, NVIDIA, Broadcom, that whole gaggle that just kind of went crazy last year.
All right, Frank, your perspective on what's happening right now.
Well, clearly we have a chaotic and uncertain market, and the markets hate uncertainty. The economy will be impacted by what's happening, provided it actually happens. One of the things that I've noticed is this seems like we're on again, off again. Today, for example, Trump, because of Quebec's holding back or putting tariffs on power they sell us, electric power they sell us, he increased he theoretically increased the tariff on steel and aluminum from Canada. Now, will he flip that tomorrow? That's the problem. You don't know. It creates all kinds of chaos. I have one large concern that has nothing to do with any of this stuff. It has to do with the real estate market, which represents an incredible amount of wealth in the United States, and it also represents an incredible amount of debt in the United States. As I see what's happening in Pittsburgh and other major cities, there's a lot of debt that's going to be in trouble, and I'm concerned about the banking system if that stuff is not addressed. And quite frankly, I don't know how you address it. This is a new phenomenon in my mind. I'm sure it's happened before in history, but I don't know when. I mean,
All right,
everything-
I'm going to interrupt you just for a second, Frank. If you can explain this to me, I'm not quite sure I follow because I'm not as intelligent as you
In
about these sort of
Pittsburgh,
things.
most notably, we have this building called the Oxford Center that was purchased, I think, in 2000, sometime in the 2000 teens. And they paid like $150 million and assumed some debt. Well, Rugby Real Estate just closed on it now for the debt, which was about 50 or 60 million, and they're going to put money into it. But that is a huge loss. I presume, and I don't know because they're not real forthcoming with facts here, I presume that we have some debt here that some bank is going to take a hit on, some lender, whether it be a bank or a private lender, an insurance company, or all of the above potentially. These hits are negative impacts to banks. And if the banking sector starts, I mean, money is the grease that makes everything go. And if the money starts getting tight because of losses they're incurring in real estate, because these office buildings are not recovering from COVID. It's got nothing to do with Trump. It's got nothing to do with Biden. It's got nothing to do with politics. It's got to do with COVID and the fact that people do not want to go into their office and work. Everybody's trying to force them, and the employees are pushing back. Will that end? We'll see. I suspect eventually it will, but there's going to be some bumps in the road, and every major problem we've had in my career in the stock market has been as a result of excess leverage failing. Every one of them, and other than the COVID one. And I mean, 87 was savings and loans failed. 98 was the long-term capital. 2000 and 2001, actually. 2000 was the failure of the dot-com, which created leverage problems. 2001 was 9/11. That one was a little different. 2008, debt. The COVID thing created some stress in the debt market, but basically sales went away. And adding to that, something you said the last time we met, Stacy, about the wealthy people representing 40%, the top 10% representing 40% of the sales. Wealthy people, because of this pullback in both the real estate market and the stock market, are going to feel less wealthy.
Okay,
If they
Kim,
start pulling back, I don't know what's going to happen to sales. Dick's today, I think, announced a reduction in their expectation for the current year. Minor reduction, but Dick's, you would think a sports thing would be somewhat recession-proof. Maybe not.
Well, you hit on something here as we've all talked about before, and that is the economy is driven by consumers, and it makes up close to 70% of the economy. Kim, you've been wanting to say something. Go ahead.
Yes, I agree completely up to a point with Frank that all of these crises and all recessions that we've had other than 9/11 in the last, I don't know, 30 years have been credit driven. Now, something that has been creeping up since the last credit issue is most of the banks aren't doing as much lending as you'd think, even in syndicates for like these big buildings or big projects. What's come in is private equity, and private equity has been sold to investors, and it's filtered down now to more or less regular, high affluent or affluent, and the next level, mass affluent, are buying private equity funds. Here's my problem with private equity. This isn't like woebegone. Not every child is above average. And you don't really know what your private equity group that you've bought into, how good they are. And people tend to be terrible underwriters whenever everybody else is in a space lending money to, and they just want deals, right? They have all this money coming in, they want deal flows. So this private credit is extremely dangerous, and nobody's been talking about it. I think advisors really love it because it's not something that's marked to market every day. So I think a lot of people have bought into this. Not sure the advisors around on the table today do this. I think they're well aware of, the whole Lake Wobegon problem, that not every group that hangs a shingle is brilliant. So, there are issues, and I'm expecting them to come out in private equity.
All right, Kim and Michael, you guys are financial advisors. Give us your take then, what Kim just said and what Frank had to say.
Well, I can tell you where we are, and I'm so glad Kim brought up private equity because really it's private credit, right? Private equity, same thing. You're buying credit instead of equity. So here's how this plays out, right? Really important for people to understand. Michael said it, that generally when you have a recession, it's led by unemployment, etc. In February, there were more the last time we had as many job cuts as we did in February, which February was July of 2020. Our job is to get ahead of the curve, right? That when it comes out in the data, it's already too late. So we are starting to see, I get it that the unemployment number wasn't, it ticked up just a bit, nothing to be concerned about. But we are starting to see some things percolate when it comes to job cuts. Pitt has announced that they have a hiring freeze for the rest of the academic year. We're starting to see it because people are nervous. If we do get a recession, and let me tell you, to hope that we don't get a recession is not an investment strategy. Hope is not an investment strategy. So we, as advisors on the front lines with our clients, we're actually thinking, okay, let's say we do go into a recession. What do our clients need to be doing and thinking about? The first thing that they need to be thinking about are their cash flow needs and their time frame, and then their risk tolerance. We are now in the process of reassessing our clients' risk tolerance. When we talk to a client about risk tolerance and the market's going straight up, it's very different than when the market's going down and they're afraid. So it's our job to assess that. If we do head into a recession, that's where these private credit issues start to unwind. And it's a big deal. So as Kim said, no one's talking about it. Occasionally you'll see a little article. February 28th, there was a little article in the Wall Street Journal. This is something that as advisors and as investors, we need to be careful of. Frank said it, that the banks, getting concerned about the banks because of their lending. Well, now we've got all this lending going on that no one knows about. Very similar to kind of like the breakdowns that we saw in 2008. Now, here's the good news. 2008 took 2 years to recover from that. So when we're talking about timeframes and risk tolerance, we have some metrics we can go back to.
Michael.
I'm not sure there's a whole heck of a lot I can add there, to be honest with you, Stacy. Yeah, I'm at a loss I'm for once at a loss for words.
And as for normal, I am not. HF Management manages private equity, private debt, and that's what we do. And every partnership I have invested in has some degree of major or minor stress. The worst ones, believe it or not, because I would have never believed this, are the apartment deals in the Sun Belt. It's incredible how many problems these guys are having. The rise in interest rates, most commercial loans, you can't get a fixed rate for 15 years. You get it for 5. Well, the 5 years is coming up and it's getting reset, and it's not at 2 anymore. It's now at 7 or 6 or whatever. And that's changing the dynamics. All these things are nobody sees them, as Carrie so very well said. And what concerns me, I've been doing this sort of thing we started this partnership 6, 7, 8 years ago, and it was under the radar. Now the big guys, and I'm going to say this because they're doing it in search of fees, are bringing deals down to people who do not understand this cannot be sold. You have to live through it. It should only be invested in by people who can ride the roller coaster ride, because it is a roller coaster ride. There's no doubt about it. These things are designed to be 5, 10, and 15-year investments. And through that period of time, all sorts of things happen. And right now, a lot of things are happening simultaneously, which is not generally expected.
I have to ask this question. staying with this particular part of the subject, and that is, does the average investor, is he or she affected by this sort of thing? I.e., let's just say we're talking about people who are employed somewhere, they have a 401k, they're into the ETFs, this sort of thing. Does this hurt them, or is it because the economy starts to go down, it affects them?
It can, because they're starting to open this up, the 401ks. I hope it fails. It doesn't belong in 401ks. It doesn't belong for the average person who is headline driven. They cannot deal with the sort of, one of the apartment buildings that one of my investments owns is in Georgia, outside of Atlanta. And when COVID hit, they put in a no eviction policy. That thing just went off last year. So they've been having squatters in this property. The general partner was talking about donating the property to a charity just to get rid of the headache, because there's nothing they could do about it. And now, fortunately, the state of Georgia took that no eviction, so they're actually able to manage now. But that property is going to be not what was expected when it was purchased years ago.
Okay. Any other comments about this particular part of what our discussion right now?
Probably the biggest losses that you're going to see are in headline losses would be in endowments for universities, that kind of thing. And
Okay.
that's where I'm really expecting it, because they chase that market extremely hard.
I think it's called the Harvard model,
and they're
right?
kind of bad. They're always like a half step off. Back in '99, same thing happened where they were chasing hedge funds. So,
Yeah,
go ahead.
I was going to say, I think, listening to this dialogue, you can really get kind of nervous. And I think that it's important for individual investors to understand we have hiccups like this. It's so easy to forget. But if you're working with a good advisor that can help you work through your emotions, right, and create an investment strategy so that you can live through the volatility, that's what we have to do. This is not about going to the sidelines. It's about creating an investment strategy that is matched to your goals, your cash flow needs, your retirement needs, and also your risk tolerance. It's very hard to do. I think that the challenge is for investors that don't have advisors, that maybe haven't had the experience of how you actually maneuver through this. And what we do as advisors is we use those good times, right, to be able to take tax opportunities when we see them, rebalance portfolios. The biggest challenge that I'll say that the person that doesn't have an advisor, the biggest challenge they have is they have portfolios now that have huge capital gains because they just let things ride.
Yep.
And then you get into an environment like this and you don't want to sell because you have a capital gain to take and they are paralyzed. So instead of paying taxes, they lose money. So, that's part of the value of working with an advisor is to help you manage taxes in good times and in bad so that you can achieve your returns.
And
Excellent.
one more de-escalation of panic. The amount of money we're talking here is not like in 2008. It is not like on every bank's balance sheet like the mortgage industry was. So, let's just walk this back. But you were asking, where could it blow up? And that's where we think it can blow up.
Okay. Well, let me go back to something else you said earlier, Kim, and if that's all right. And that is that you said that part of this downturn that we have is because of AI and
Right.
these the Magnificent Seven or whatever they happen to be. Is there a parallel then to what happened in the dot-com bubble with these? And that took several years for us to really climb out of. Of course, 2001, the 9/11 didn't help. Michael, you're shaking your head no, so we'll get to you too.
I'm going to be a big nerd and say that this is more like the telecom kind of issue where people were putting money into things like Lucent and Juniper Networks and all these like weird little companies that they thought were going to triple and double and quadruple because these new telecoms were going to start up and reproduce the existing telecom networks. That's what people thought. And I'm talking from like 97 to maybe 2002. 2002 is when it all kind of like went down. But now we don't use old-fashioned telecom. We use the internet. And that's what happened was there was a dramatic change in all of our phone calls are now internet-based. You don't know that, but that's the truth. So that's kind of what I'm talking about. And yeah, it might take 4 or 5 years for this thing to work out, maybe not in individual names, but actually to deliver value. I'm still not seeing value other than, like, what do I make for dinner tonight with these 3 elements? But nobody's paying for that. I'm talking about companies paying for access to AI that allows those billions that were spent to be paid back.
Yeah, and the AI story is just a subset of the Magnificent Seven. I mean, you think about Apple, Google, Microsoft, Facebook to an extent, they are so big and have their tentacles in so many different areas of the economy that it's completely different than what we saw in the dot-com bubble, where Ask Jeeves was just tied to internet search, and Ask Jeeves failed because Google rose. The earnings growth expectations, and Kim can talk to this better than I can, are still fantastic for all those companies over the next 1 year, 2 year, 3 year periods. They're going to continue to grow their earnings whether or not AI is going to be a revolution in the next 3 years or not. And I'm not really talking about NVIDIA because that's a little bit of a separate story. That really is tied to the AI story. But Microsoft has it. Google is in driverless cars and internet search and so many other different areas of the market and the economy that it's just completely different than I think what we saw in 2000. That doesn't mean that they can't go down because their valuations got incredibly stretched. And as Carrie mentioned, we came into the year essentially priced for perfection. And when perfection doesn't work out over a quarter or two, you're going to get hit. And that's what we just saw over the past month or so, in my opinion.
All right, let me ask you this question, and it goes something similar to what Carrie was just talking about, and that is, should you sell on a down day?
I mean, I really think that it comes down to why you're selling. Honestly, it depends. You don't want to sell just because something's down. This is where the analysis comes in. The companies that we own, we're very close to them. We know why we own them. And if something fundamentally changes, I don't care if it's an up day or a down day, we're gonna sell it and move on. I think one of the things that we actually really like about volatility, I think Kim might agree with me, is that it does give us opportunity. It gives us the opportunity to upgrade our portfolio. So, we and part of the other thing is that we're not about like, okay, let's sell XYZ and buy ABC today. Sometimes, especially if the market's down, we might just be like, okay, let's sell and wait. So last week in our portfolio, we sold something, we didn't reinvest it, and we're probably going to have the opportunity to buy something better at a cheaper price. So I don't think the day necessarily matters, but I will caution and say, the biggest up days in the market come immediately following the biggest down days. So there are all kinds of like charts and graphs to show if you take out the 5 best days of the market, what does that do to your return? So, now is not the time to be really switching up your investment strategy necessarily, which is why our job when times are good matters, because we're constantly preparing our clients and our client portfolios for times like we're in right now.
We are about out of time, but I do want to ask this question because people retire and they're starting to see this, and let's just say they plan to retire next month. Should they wait or just go ahead and do it? I mean, with the markets down, they probably have lost a little bit of money in their accounts.
It's a math problem.
Yeah, I mean, it really, this is a really good point, Stacy, because again, if you are retiring at some point in the future, within 7 years, you really should be either doing it yourself or working with an advisor to make sure that even if your retirement date hits, a time when the market's down, The question is, okay, how do you transition that now, right? So that you can still generate the income. Waiting to retire to pay attention to this is kind of too late.
Okay.
It's never too late, but it presents more challenges. The bigger issue for us right now are 529 plans, because your kid's going off to college, you can't say wait a year. So we've really been very active in making sure that that need for our clients, we're not going to mess around, and we'll give up 10%, 20% to make sure that the kids can go to college.
Okay. Anybody want to wrap it up for us here?
Yeah, that was
Let me
lovely.
just
That
say,
was
let me
perfect.
just say something that everybody has said one time or other. This downdraft in the market is not a correction. Well, it might be a correction today, but it wasn't a correction as the market opened this morning. And that correction, as Kim said, she was going shopping. I'm creating a shopping list. Carrie just said she's preparing to take advantage of this opportunity. It is an opportunity to upgrade portfolios. It's not something to run away from, it's something to run into. I would bet Warren Buffett does not have $325 billion in cash in a month. I bet he has less. We won't know until it's over because he doesn't tip his hand, of course.
Right.
But I'll bet you some of that big cash hoard he has goes somewhere because of this.
Okay. All right. I want to thank all of you, and we'll continue our look at investing in the economy in future editions. Well, still a lot of questions to be asked, and especially on the tax front. Maybe we'll be able to get into those before the actual tax day, and we can talk a little bit about that. Also ask that you hit the like or the subscribe button on whatever platform you happen to be watching or listening to this program. But for right now, thanks for joining us, and we'll see you again in about 2 weeks or so.